All right, today we're discussing one of my favorite topics, real estate, and more specifically, what is a mortgage. First off, if you're new to the channel, my name is Joseph Gonzales, and if you're returning, welcome back. Today I want to discuss what a mortgage is because I know a lot of you are probably in the season of your life where you're trying to possibly purchase a home and or use real estate to build wealth, and I want to discuss this as a foundation on helping you understand exactly what a mortgage is and how to utilize it. So a mortgage is essentially a loan from a bank or financial institution that allows you to go out and purchase a house. Now, the difference between a personal loan, a student loan, compared to a mortgage is essentially a bank is saying, hey, we're going to give you this money to go buy this house that you want, this dream house, this first house, right, to start your family, however you're going to use this house. We're going to give you this money here, and then you're going to go out and you can go purchase the house that you want to purchase. Now, the difference between this mortgage that you're getting, this loan for a home, is that if you don't pay your mortgage, the bank can basically use your home as collateral and they can take your home away if you're not making your mortgage payments. So in order to give you an idea of how this looks, whenever Stephanie and I were getting married, we decided that we wanted to purchase a home together. Now we did it a little backwards. We bought the home before we got married, but we knew we were going to get married, and we've been married for a decade plus now. We've been together at least for a decade plus now. But essentially what we did is we said, okay, we're going to want to buy a home together. What do we need to do? We don't have the money to go buy a $300,000 house cash. We just don't have that money. Most people don't. By the way, the majority of people finance a home. And so what we did is we said, okay, let's go to a lender and or to a bank, right? So a mortgage professional and or a bank, and let's find out how much we can get approved for. Well, we got approved for way more than we needed. What that allowed us to do was go out and purchase this home. So a mortgage allowed us to go buy a home because we took a loan from a bank that said, hey, here's the money you need. Go pick the home that you want, and then you'll be paying us back based on certain parameters that we're going to talk about in just a bit, such as a down payment. Okay, now that we know what a mortgage is, let's talk about the intricacies of how a mortgage works. Most of the time, what's going to happen is you're going to go to the bank or to the lender and they say, hey, do you want to put down a down payment, and how much down payment do you want to put down? Now, there is this myth that you have to put 20% down. I want to explain to you now, you do not have to put 20% down. There are different first-time homebuyer programs, as well as other programs such as FHA that allow you to put as little down as 0 to 3.5%, but you have to qualify for those things. Now, for Stephanie and I, I'm going to give you some rough numbers on what we did. We said we want to put down, I believe it was 5% of a $300,000 house, so essentially $15,000. So we had that money saved. Stephanie had been working for her company for a while, and so that allowed us to take that money and put that money down, and the bank to agree to loan us the money that we needed for the house. Now I want to repeat something here. You do not have to have 20% down. Most people don't have that saved. However, if you do, congratulations, you're in a really good spot. You can use that money to put 20% down. So example again, if you're buying a $300,000 house, that would be $60,000. So essentially we take 300,000 times 20%, and that gives us about $60,000. Now, again, you don't have to have 20% down, and most people don't. So don't feel like you're behind if you don't have 20% down, or that you have to continue saving for the rest of your life to get to 20% down. What you want to do is go talk to a lender or a mortgage professional to make sure you know exactly how much you need to be able to put down in order to get a specific loan for yourself. Now that we know what a mortgage is and we know what a down payment is, the next thing is understanding the full scope of this mortgage. So let's take an example of $300,000 like I was discussing earlier with a 5% down payment. What happens now is we said, all right, 300,000 times 5%, that's 15,000. That leaves us with an additional $285,000 that we need to get from the bank. So we're buying a $300,000 house. We are putting down 5%, which is 15,000. So we subtract 15,000 from 300,000, which gives us $285,000. So the bank is going to give us that amount for the home. Now, what happens next is you have to discuss what your interest rate is. Interest rates, depending on the time of year and what year it is, are going to vary. All right, I've seen interest rates anywhere from 3%, which is, early on in the 2020-ish range, and now in 2024 or 2023 going into 2024, we're going to see interest rates around 7 to 8%. So it just depends on where you are. So I'm going to use the number that we used previously so that you can see what that looks like. We're going to say we're going to have an interest rate of 4%. That's what we used to have, and it just makes the math easier for me. What that means is every year we owe the bank 4%, right, of the actual loan that they gave us. So we do 285,000 times 4%, and that's what we owe the bank every single year. Now, another thing to keep in mind whenever we're talking about mortgages is fixed interest rate versus your variable interest rate. Now, the majority of people in the United States are probably going to have a fixed interest rate, and then for the time frame of 30 years. That's what typical mortgages are in the United States. Now, in other countries, there's variable interest rate, and that basically allows you to have your interest rate fluctuate with the market, right? So as the government changes interest rates, your interest rate could be higher or lower depending on the year and how the government is fluctuating that interest rate. Now, with a fixed interest rate, you're typically going to get a little bit higher interest rate than you would if you just went with a variable, but you know it's fixed and you know what your monthly cost will be and your monthly mortgage will be every single month. Another way to look at this mortgage is in the course of 30 years, we have a fixed interest rate. Every single month, I know what my monthly payment is, but after 30 years, we will be the sole owners of our property. So for you, if you're going out there to purchase this property, you have to say to yourself, am I comfortable paying this monthly rate every single month for the next 30 years in order to be the sole owner of this property? And or am I willing to wait for interest rates to come down whenever I have possession of this property and I'm paying this monthly mortgage right now so that my monthly mortgage can go down? So if either one of those things works for you, obviously you go pick the house that you want to pick for you for your monthly payment specifically. So what are the advantages of getting a mortgage? Well, I think it should be obvious. The number one thing is you don't have to go out and fork out $300,000 of money that you do or don't have in order to buy this house. And the other thing is you're also not just giving money to a landlord the entire time. So the advantage is you're taking this money, you're paying the bank who gave you the loan, so you're paying a little bit of interest or maybe a lot of interest in the beginning. And then as you continue to pay that interest to the bank and you make your monthly mortgage payment to the bank, you own a little bit more of your house every year until you've got it paid off in 30 years. So one way to look at your mortgage is split into two different things. You've got equity, which is what you as a homeowner own, versus the debt, which is what the bank owns. So every time you make a payment, you're earning more equity and you're also paying the bank off at the same time so that you own that home at the end of 30 years. Now, another really important thing to note is that the majority of millionaires earned their wealth through real estate. So let's say, for example, we decide to sell this house, this $300,000 house, 2 or 3 years down the road and the market has gone up. Well, guess what? Now we can actually earn a pretty nice profit on this particular property that we own and either move up and or cash out to earn more money to help us continue to grow our wealth. So continue to think about, hey, if I can get into a home faster and make sure that I have a good monthly payment that I'm comfortable with, then I can start building my wealth a little bit faster. So what I want to do is give you a mathematical equation. So let's say we bought this house for $300,000 and we took a loan from the bank for $285,000 and then we sold the house for $485,000. So $485,000, we had a loan for $285,000. Let's say the next day we sold that house, right, for that profit, $200,000. Essentially what's going to happen is we don't actually partner with the bank whenever it comes to selling the property. So that profit margin is actually ours. Now, there's taxes and other things, and we'll dive into that later. But essentially, the bank is loaning us the money that we need, and all we have to do is pay them off the debt that we owe them, aka the loan, the mortgage, and then we get to keep that profit. And so that's why I think a lot of people go into investing in real estate, because the bank is essentially giving you that loan that you're paying off every single month and with that small interest payment, but you are not partners with them whenever you go to sell that house for a profit. So just to summarize everything, there are deeper levels to mortgages, but this is a surface level to help you understand exactly how to utilize a mortgage to go buy a property. Again, I want to remind you that you don't have to have 20% down to buy a property. There's first-time home buyer programs. Again, talk to a local lender and or your bank to learn more about that. The other thing I want to make sure that you understand is the majority of people use a mortgage to go out and purchase a home as well. So whenever it comes to purchasing a home, don't think that, oh, getting a mortgage is a bad thing. Utilize a mortgage in the smartest possible way you can. Use that as a tool to continue to build your wealth. Now, we'll dive deeper into mortgages and real estate as we continue to build this channel and give information out to you all. But if you want to learn more about things such as mortgage, building wealth, how we utilize real estate to build our own wealth, make sure you like and subscribe. Make sure you leave a comment if you have any questions or if there's anything we missed. And again, give yourself permission to go buy real estate, number one. But number two, give yourself permission to be wealthy. And we'll see you guys in the next video.